You're watching FinWorld. Welcome to my channel. Financing decision. This involves decision about the amount of money to be raised from various long-term sources. The main sources of funds for a firm are shareholders' funds and borrowed funds. The shareholders' funds refer to the equity capital by offering shares and retained earnings, which are the amount of profit left after accounting for dividend payments. Borrowed funds refer to the money or say finance raised through debentures or other forms of debt. A firm has to decide the proportion of funds to be raised from either sources based on their basic characteristics. Interest on borrowed funds have to be paid regardless of whether or not a firm has earned a profit. Likewise, the borrowed funds have to be repaid at a fixed time. The risk of default on payment is known as financial risk, which has to be considered by a firm which do not have sufficient shareholders to make these fixed payments. So the overall financial risk depends upon the proportion of debt in the total capital. Shareholders' funds, on the other hand, involve no commitment regarding the payment of returns or the repayment of capital. There is no such compulsion to pay any dividend on equity shares. A firm, therefore, needs to have a judicious mix of both debt and equity in making financing decisions, which may be debt, equity, preference share capital, and retained earnings. Let's move forward to the factors affecting financing decisions. Some of the important factors which affect the financing decisions are as follows. First is the cost. The cost of raising funds through different sources are different. Some sources may be cheaper than others. For example, debt is considered to be the cheapest of all the sources. Tax deductibility of interest makes it still cheaper. So, the cheapest source can be selected. Second is the risk. The risk associated with each of the sources is different. Like the cost, different sources have different risk which needs to be considered. Next are flotation costs. The fundraising exercise also costs something. This cost is called flotation cost, which must be considered while evaluating different sources. Source with higher flotation cost will be less attractive. Fourth is the cash flow position of the company. A company having stronger cash flow position may prefer debt financing over equity. Fifth are fixed operating costs. If a business has high fixed operating costs, for example building rent, insurance premium, salaries, etc., it must reduce fixed financing costs, and so lower debt financing is better. Similarly, if fixed operating cost is less, more of debt financing may be preferred. Sixth point are control considerations. Issues of more equity may lead to dilution of management's control over the business, which means that with the issue of more shares, the company faces reduction in the percentage of existing shareholders' ownership in a company. In such a case, companies would prefer debt to equity. However, with debt financing, there is no such implication. Seventh is the state of capital market. Health of the capital market may also affect the choice of source of fund. During the period when stock market is rising, more people invest in equity. However, depressed capital market when stock prices fall, this will make it difficult for any company to issue equity shares. So, financing decision is thus concerned with the decisions about how much to be raised from which source. दिस वॉज ऑल अबाउट फाइनेंसिंग डिसीजन। अगर आपको वीडियो पसंद आई हो तो लाइक, शेयर और सब्सक्राइब कीजिएगा। प्लस अगर कोई क्वेश्चंस है दे कैन आस्क ऑन द कमेंट सेक्शन बिलो। सो ऐसे ही और वैल्यूएबल इन्फॉर्मेशन के लिए जुड़े रहिए फिन वर्ल्ड के साथ। थैंक यू ऑल।